The nature of the American approach to the conflict has fundamentally and irreversibly changed. The period of ambiguity and political games is definitively over. The cancellation of the highly anticipated summit in Budapest was the public signal that the American administration had abandoned the role of diplomatic mediator and pivoted to a strategy of direct economic coercion. This shift is not merely a change in tone, it is the most significant strategic escalation against the Russian Federation since the beginning of the war. This is FPV Explainer, where we break down the most fascinating stories in drone warfare. If you're enjoying this deep dive, hit the like button, subscribe, and drop a comment telling us what topic you want to see next. Your feedback shapes our future videos and keeps us bringing you clear, detailed analysis from the front lines. Also, please watch this video to the very end, even if you play it in the background without sound, as your continuous viewing is critical to help promote the truth about the war. The core of this new strategy is the sanctions shocker, a targeted, crippling assault on the very financial heart of the Russian state. The decision to implement direct, blocking sanctions against Rosneft and Lukoil is not simply an addition to a list, it is a declaration of economic war. These two companies, along with the other major producers already sanctioned, represent approximately 75% of all Russian oil production. By targeting these giants, the administration has moved beyond symbolic gestures and delivered the first real crushing blow to the source of war funding. This move is strategically crucial because it eliminates the Kremlin's last remaining safe havens. The previous administrations had carefully avoided sanctioning these key exporters, fearing a sudden shock to global oil prices. The current administration, realizing that caution only emboldened the aggressor, has decided that the risk of further escalation and war prolongation outweighs the risk of market volatility. This action demonstrates a political resolve to impose an existential cost on the Russian state. The immediate impact is the rupturing of Russia's primary financial arteries. These companies can no longer rely on US dollars for settlements, nor can they easily access the global financial infrastructure. This is particularly devastating for trade with key buyers like India, where many large transactions were still conducted in US dollars, effectively cutting off the mechanism that provided the Kremlin with the hard currency necessary to sustain its massive military expenditure. The message is clear. The United States is no longer observing, it is actively fighting the war by asphyxiating the enemy's financial lifelines. This escalation fundamentally changes the cost-benefit analysis for continuing the war.
We have established the political resolve driving the new sanctions regime. Now we examine the immediate, crippling effect of these measures, which target the singular financial lifeline sustaining the Russian war machine, its crude oil exports to Asia. The goal of this phase is clear: to accelerate the systemic collapse of the Russian budget by rendering oil export revenue, the final pillar of the nation's solvency, functionally worthless. The core of this offensive is the deliberate strategy to disrupt dollar settlements and amplify compliance risk for Moscow's remaining major buyers, primarily India and China. While the previous administration sanctioned smaller entities, these new restrictions on Rosneft and Lukoil have immediately created an unmanageable crisis of trust in global financial circles. These companies can no longer rely on the seamless functioning of dollar transactions for their oil sales. Even if crude is nominally paid for in rupees or yuan, the underlying correspondent banking relationships remain vulnerable to U.S. financial isolation. The message to Asian banks is unambiguous: continue processing Russian oil payments and risk being cut off from the global financial system entirely. This threat has achieved immediate, measurable results. Major Indian state-owned refineries are now preparing for a sharp reduction, if not a complete cessation, of Russian oil imports, fearing the catastrophic consequences of violating U.S. sanctions. Similarly, key Chinese state-owned companies have paused new purchase negotiations, waiting for legal and financial clarification on the extent of the compliance risk. This collective global self-sanctioning is not an act of benevolence. It is a pragmatic recognition that access to the U.S. financial system is far more critical than discounted Russian crude. The immediate financial consequence of this disruption is devastating for the Kremlin. The primary revenue stream is contracting rapidly, accelerating the already critical budgetary crisis. Official figures confirm that Russia's oil and gas revenues are already running at least 50% below the original projections for the current year. This shortfall is directly attributable to a combination of factors: the loss of the high-profit European market and the deep, forced discounts Moscow must offer to Asian buyers. The new sanctions now actively compound this problem by adding immense logistical and financial friction. The state budget is thus staring down a future with an unmanageable systemic deficit, projected to reach several trillion rubles, as the primary mechanism for generating hard currency is severed. This economic pressure is further amplified by the active maritime blockade of Russia's shadow fleet, the aged tankers used to bypass sanctions. By systematically disrupting and seizing these vessels, the international coalition is increasing the insurance and transportation costs for Russian oil to commercially unviable levels. This reduces the already thin profit margins, acting as a relentless physical financial squeeze. The entire strategy is designed to ensure that the war effort, which is dependent on this foreign currency, becomes financially insolvent. The collapse of oil revenue is not merely an economic problem. It is a decisive strategic victory for the West, guaranteeing that the war of attrition is fought not only with depleted men and materiel, but with a rapidly emptying treasury.
We have analyzed the immediate financial assault on Russian exports. Now we confront the most devastating internal consequence of that economic strain. The military-industrial complex has stalled. This is the ultimate operational failure, confirming that the defense sector is no longer the engine of growth the Kremlin claimed, but a vast, inefficient sinkhole that is running out of fuel. The core shockwave hitting the Russian system is the sudden, dramatic collapse of defense production growth. For nearly 3 years, the only sector showing sustained expansion in Russia was the military one. Now that is over. Official data from September confirms that growth in industrial production has slowed to near zero, with the rate in the critical processing industry falling to its lowest point since early 2023. More alarmingly, the production of ready metal products has declined into the negative, and the output of transport vehicles, tanks, and armored personnel carriers has slowed dramatically. This is not a slight downturn, it is a profound stagnation. The war machine, which must run at maximum capacity to sustain the war effort, has been brought to a crippling halt. This unprecedented stall is not due to a saturation of the Army's needs. It is due to systemic, unresolvable financial and structural deficits. The massive budget deficit creates a financial hunger that the MIC cannot satisfy. While the state pours money into the sector, the funds are simply insufficient to cover the escalating costs. The industry is trapped in a corrosive cycle of undercapitalization. The financial market is compounding this problem. High-risk corporate entities in the MIC are facing massive difficulties accessing affordable credit due to the central bank's high interest rate policy. This policy, designed to fight inflation, simultaneously chokes investment and prevents companies from fulfilling long-term military contracts. The war machine is literally running out of cash to purchase raw materials and pay for necessary equipment upgrades. This financial starvation is exacerbated by the deep structural corruption and monopoly pricing that define the Russian MIC. The entire defense sector is riddled with inefficiency. State defense corporations and specialized firms are notorious for overstating costs on government contracts while failing to deliver on time or with sufficient quality. Decades of corruption mean that vast sums were poured into the sector, yet much of that money was siphoned off, leaving the production base brittle and technologically backward. The sector consumes immense resources, but is unable to translate those resources into effective, high-volume combat assets. The military command, therefore, is faced with an operational nightmare. The stalling of the MIC means that the Army is losing its ability to replenish the strategic reserves of tanks, artillery, and ammunition consumed by the war. This failure has already led to the desperate deployment of outdated materiel and the reliance on unstable foreign suppliers. The ultimate strategic indictment is clear. The supposed main competitive advantage of the Russian state, its powerful military-industrial base, is proving to be a paper shield. The inability to sustain production growth is a direct, quantifiable indicator that the war of attrition is now unwinnable. The system has failed its core mission.
The confluence of military defeat and reckless fiscal policy has plunged the Russian economy into a state of acute crisis, a situation marked by devastating fuel shortages and an uncontrollable surge in inflation. This isn't just an economic recession, it is a full-blown financial shock, where the government's own actions guarantee the further degradation of the standard of living. The first and most visible front of this economic collapse is the fuel crisis. This is a direct consequence of the successful Ukrainian kinetic sanctions campaign, the sustained, precise drone strikes on Russian refineries. The resulting physical deficit has sent the price of gasoline soaring, with retail costs rising by more than 10% since the start of the year, a rate that far exceeds official inflation figures. This shortage is amplified by cynical market abuse. Major state-aligned oil companies are hoarding fuel and prioritizing their own branded stations, starving independent operators of supply. This maneuver, while enriching favored oligarchs, accelerates the market's collapse and proves the government's utter failure to stabilize a crucial industrial sector. This crisis is compounded by a reckless fiscal policy that is actively fueling inflation. The government is preparing a gigantic, disruptive cash injection into the economy to meet its immense military spending obligations. To execute the final portion of the annual budget, a staggering 12 trillion rubles must be spent in the fourth quarter alone, October through December. This is not sustainable spending. It is a desperate, massive release of funds into an economy already suffering from systemic shortages. This sudden spending is a guaranteed inflationary impulse. The money is being pumped into the system faster than goods can be produced, ensuring that the already high prices for commodities will accelerate uncontrollably, leading to a profound devaluation of the ruble and an inevitable decline in purchasing power. The central bank is now caught in a vicious, self-defeating loop. The latest data confirms that inflation has surged to over 0.21% weekly, confirming a continuous upward trend. This soaring inflation is being driven by the combination of the fuel crisis and rising food costs, making it impossible for the central bank to meet its inflation targets. The economic managers are trapped. They cannot lower the key interest rate because that would unleash hyperinflation, yet maintaining the high rate chokes off investment and drives up the cost of servicing the state's crushing debt. This paralyzing contradiction ensures that the financial crisis will only deepen, making the war structurally unsustainable and ensuring that the Russian population is forced to pay the highest price for the political failure of its leadership.
The overwhelming evidence presented by the economic analysis converges on a single inescapable conclusion. The confluence of financial, industrial, and geopolitical crises has created a strategic dead end for the Russian Federation. The nation is structurally incapable of financing the war effort, and this terminal insolvency is the decisive factor that will ultimately compel the leadership to cease active aggression. The systemic failure of the Russian economy is no longer a forecast. It is a reality dictated by collapsing revenue and escalating expenditure. The financial lifelines are severed. The most critical energy giants are now under direct sanctions. Oil revenues are plunging, and the ability to raise capital through international markets is paralyzed. The state is trapped between a political commitment to a massive war budget and an economic reality of shrinking income. This financial crisis dictates the only remaining path for monetary policy, a path of economic destruction.
The central bank is compelled to maintain a high key interest rate, which currently stands at a crippling 17%, not because it desires a strong ruble, but because it is the only remaining tool to fight budget-driven inflation and the threat of hyperinflation. This high rate, however, acts as a financial poison for the civilian economy. It chokes off all investment and credit in the real sector, pushing vital industries like manufacturing, construction, and agriculture into a state of continuous decline. The very industries required to sustain the nation are being deliberately strangled to pay for a war they cannot support. The crucial takeaway is that the costs of the war have been converted into an irreversible internal mechanism of collapse. The system is operating under the belief that it can outlast the support for Ukraine, but the economic data confirms that its own financial reserves and industrial capacity will be exhausted first. The political decision to stop the aggression will not be made out of a sudden change of heart, but out of absolute necessity. The financial squeeze ensures that the only viable option left for the leadership is to accept the ceasefire, stop the bleeding, and prevent the system's complete disintegration. The strategic bankruptcy of the war effort is now complete.